tax planning. Now, what is actually a tax? Tax is actually a mandatory fee, a particular financial charge which will be levied by the government. Okay, and it will be levied upon whom? It will be levied upon individual and the financial institution, so that the particular revenue can be collected. It can be used for the public works, for improvement, and for infrastructure, for best facilities over there, right? So it's particularly what? It's a mandatory fee or financial charge charged by the government on individuals and organizations, so that it can be used for improvement of the infrastructure and providing the best facilities and further infrastructure, right? So that's the thing. And if we talk about the taxation, taxation is a system. Taxation is a system by which we are collecting, or particularly we are levying the taxes from the individuals, businesses, and the other entities by a government authority over there. So taxation is actually run by the government over there. And in India, both the central government and the state government, they are having a role in setting up and levying the taxes over there, right? That's actually related to taxation. And if we talk about the tax structure in India, we are having two types of taxes. One is related to direct tax. Let's say the case that you earned an income of rupees 5.80 lakh and the taxable income. Now in that scenario, what's the tax will be charged? That will be charged directly to you, right? That's an income tax. Let's take the example of income tax over there. Now that particular charge will be down, that particular tax will be charged, and you are to pay. You are having the obligation, you are having the liability so as to pay that particular tax directly to the government over there. That's a direct tax that's directly imposed upon you. And direct tax particularly cannot be passed to another user over there, right? He or she has to pay it himself or herself, right? And the other one, it's related to what? It's related to the indirect tax. Now, what do you mean by indirect tax? Now, indirect tax is not directly imposed on you. Let's say the case, I purchased a biscuit pack of Parle G. I purchased a biscuit pack of Parle G. Now, I paid an amount of rupees 10 to the shopkeeper, right? Now, in that scenario, what happened? I actually paid a tax. What type of tax? I paid GST, that is goods and services tax. Now, this goods and services tax was paid by me, but now it's not my obligation. It's not my obligation so as to particularly pay that particular tax to the government over there. The shopkeeper will be having the liability because he has made the sale. Now, he is having the liability so as to pay that particular tax to the government over there, and it will be paid to the government in that scenario, right? And it is levied on your consumption or expenditure or transaction of goods over there or services over there. That's a particular the indirect tax, that is a GST, right? After that, it's related to Income Tax Act 1961. Now, income tax is what? Income tax is a central subject according to the Constitution of India. What does it indicate? It means that the income tax is levied only by the central government of India. It will be levied only by the central government of India. That's we are talking about the income tax over there. Now let's understand the different terms in the income tax. First of all, it's related to assessee. Now, who is assessee? Let's say case we are talking about a person who is having some particular taxable money to be paid. Now in that scenario, that person is an assessee. That person is assessee. Let's say case person A is to pay the tax. Now person A is assessee. Now person B is to pay the tax. Person B is also assessee. Okay. And if we talk about the definition of the person, different type of person definition has been covered under the Income Tax Act 1961. And first of all, it covers the individual. Now, who is individual? Individual is a natural person which is a human being person over there, and it is considered as a separate entity for tax purposes over there. For tax purpose, it is considered as a separate entity. Like we are having person A, B, C in the family, and particularly they are having income. Now they'll be considered different persons for taxation purposes over there, right? And particularly second one, it's related to HUF. Now HUF is Hindu undivided family. It's Hindu undivided family. Now it basically consists of all the person which are there from common ancestor, and they are running a common business, a family business of their own, right? So in that scenario, that's what that's forming a HUF. That's forming HUF, and for taxation purpose, the HUF returns are filed separately, right? And further, it's related to company. It's related to company. Now, company can be an Indian company, which is basically constituted in India, which is incorporated in India, and it can also be a foreign company who is incorporated outside India, but it's having a place of business in India also, right? And the company which is registered under the Companies Act 2013, and it includes both public companies as well as the private companies over there. And if we talk about the partnership firms, these include the partnership firms, which basically are commonly there so as to basically share the profits and particularly working for some single objective over there. And it also includes a the limited liability partnerships which are covered under the different act, right? And particularly those are also covered. Now if two or more individuals, they are joined together, who join together for a particular business purposes, and they share the profits and losses over there, that's particularly a partnership firm. After that, it's related to AOP. Now AOP is what? AOP is association of persons. Let's say case there is a group of persons who has come together, who has actually come together, and they are having a common purpose for the same. There is a common purpose for the same. That is actually what? It may be related to carrying a business or particularly carrying a profession over there. That's actually AOP. That is a association of persons can be there, right? Let's say case it's a particular body of people over there, right? That's actually the association of persons. And other than that, it can be body of individuals, where two or more individuals who come together so as for a common purpose, and further they can be carrying a business, a profession, or some other activity also. Let's say case they created a trust for the same or something like that. That's the body of individuals, or it may be a club also, right? And particularly after that, it's related to local authority, like we are talking about the municipal corporations, MCs over there, or panchayats over there, or government bodies over there who are at local level over there. They are considered persons for tax purposes. They are considered persons for tax purposes. So these are the definitions. Other than that, we are having the AJP. AJP is artificial judicial person. Now the person who is not covered in any of the above categories, that will be falling in the AJP category, right? So we are having the individuals. If we talk about the different categories, we were having the individuals, we were having the HUF, we were having the companies, whether it's a foreign company, an Indian company, private limited company, or public company. And other than that, we are having the partnership firms, where we cover the partnership firms, as well as we cover the LLPs. We were having the association of persons, we were having the body of individuals, and other than that, we are having the local communities or local authorities, and further we were having the AJP, that is a related to artificial judicial person. Okay, so these are the different persons as per the Income Tax Act 1961. Now let's have a look at the different heads of income. Let's have a look at the different heads of income. First of all, it's related to income from salary. That is particularly income that you have earned from your employer under the employment contract over there, right? It basically covers any kind of financial compensation which is actually received by the employee, okay, by the employee over there, whether it's related to salary, whether it's related to any advance you have received, or any benefits, or particular commission, or any pension, or any other type of remuneration that you have received, that will be covered under the income from the salary. That will be covered as a income from the salary under the section 15 of the Income Tax Act, right? And further, it may be related to income from the housing property. Let's say case that you are receiving the rental income from the property. Individual is having a property, and further they're having a legal interest into that particular property over there, and they're basically receiving interest for the same. That is the income from the housing property over there, right? And the primary component is actually related to rental income that you're receiving. It may be related to rental income that you're receiving from the tenants who is occupying that particular property. Okay, and the third one is related to income from profits or gains from business or profession. Let's say case I'm a self-employed person. Okay, I'm a self-employed person, or I'm running a business of my own. Now I basically generated the profits from the same. Okay, that's particularly covered under this particular head, section 28, income from profit, income from profits and gains from business, or maybe from the different profession also. Profession income is actually related to what? Let's say case the person is a doctor and he is receiving a consultation fee, or particularly a CA, or particularly a lawyer, advocate, they're receiving a consultation fee, professional fee, right? Now that is also chargeable under the tax over there, right? And it covers a business income I told you, or the professional income I told you, right? And also it can be related to income from the capital gain. Now what do you mean by the income from the capital gain? It's related to that, let's say case we were having an asset, whether it's related to stock, whether it was related to debt securities, or particularly it's related to the property over there. That's an asset over there, right? And let's say case we acquired the asset at rupees 2, and particularly we sold at rupees 10 over there. We sold it at rupees 10 over there. Now the difference between the two is actually the capital gain that we had. That's actually to 8 rupees over here is showcasing what? It is showcasing the capital gain over there. Now this particular capital gain, this can be short-term capital gain, and also it can be long-term capital gain. Now if the short-term capital gain is actually related to where you were holding the asset for lesser than 12 months, and if you are holding the asset for the longer than 12 months over there, it will be considered as long-term capital gain over there. And in case of short-term capital gain, higher percentage of the TDS is charged, whereas in the case of the long-term capital gain, lower percentage of the TDS is charged, right? And also as I told you, short-term capital gain is actually related to when you are going to sale of the asset is done after acquiring the asset or holding the asset for at least for 1 year, right? At least for sorry, lesser than 1 year, not at least for 1 year, for lesser than 1 year, that is considered as short term capital gain over there. And when you're holding the asset, acquiring the asset and holding the asset for 1 year or more, then it is considered as long term capital gain. Okay, then it is considered as long-term capital gain when you're holding the asset for longer than 1 year over there, right? And further, it can be if you're receiving the income for any other purposes and the purpose is not specified as above, then it will be considered as income from other sources. Let's say case that you have received the income as a particular housing property or any other business properties over there, and further it's not falling under the criteria of the income. Let's say case you received some commission, you received some commission. Now it's not your salary. No, it's not your salary. It's not related to your main profession also or business income also, right? And now in that scenario, it will be considered as what? It will be considered as income from other sources, right? You need not to basically cram the different sections over there. It's not necessary. You just need to learn the meanings of the same, right? And after that, it's related to assessment year. Now, what do you mean by assessment year? It's actually the period of 12 months. It's actually a period of 12 months which is commencing from the 1st of April every year and ending on the 31st of the March of the next year. Let's say case the assessment year for this particular would be for 2024. The assessment year would be what? It will be from 1st of April 2024 to 31st of March 2025, right? And what does it indicate? It is particularly year in which assessee who is actually liable to pay the tax. Okay, assessee is liable to pay the tax on the income of the previous year. That in this particular period, I'll be liable to pay the tax for the previous year. For the previous year financial year means the financial year for this particular assessment year would be what? It would be 2020, 2023, 24. This will be the financial year, and the assessment year would be 2024, 25. Right? So this is the financial year and this is the assessment year over here. Because for this particular year, whatsoever I have earned in the previous financial year, I am to pay the taxes upon the same in the assessment year 24, 25 over there, right? So that's the scenario, right? And further it's related to TDS. Now what is TDS? It is tax deducted at source. It is tax deducted at source. That's actually the related word, that if any person or entity is making a payment, is basically whether they are receiving making the payment related to interest or related to any professional payment or related to rentals over there or related to salary over there. In that scenario, TDS, that is tax, is to be deducted at source. Then the person who is actually paying the payment is to deduct that particular tax. Let's say case person A is the tenant and person B is a landowner, right? In that scenario, person A is to deduct the TDS. Person A is to deduct the TDS before paying the amount to landlord, and rest of the amount will be paid. And this particular TDS is to be deposited by the 7th of the next month. By the 7th of the next month within the government account, right? That is to be deposited by the 7th of the next month. Okay, so that's the main scenario related to it. Okay, so that is TDS is applicable on the various type of payments such as salary, interest, rent, professional fees, etc., right? And further it's related to residential status for income tax. It's very much important. Residential status for the income tax over there. Now a person will be charged to a particular type of income or not. That basically depends upon what? That depends upon one thing, whether the person is resident or not, right? So if the person is resident, in that scenario it will be charged differently. If the person is not resident, in that scenario it will be charged differently, right? Now residentialship and particular citizenship, those are two different concepts. Citizenship and residential status, these are two different concepts over there. Now first of all, let's consider a person can have residential state. Let's understand this thing, that the person can be having the residential status in more than one country. A person can be having the residential status in India and maybe having the residential status in Canada also. Okay, so this is possible, but the person will be having the citizenship in only one country over there, right? Now in that scenario, let's understand the thing, that if the person is individual and resident in India, the person is individual, the person can be a resident in India or a person can be non-resident. Person can be resident or the person can be non-resident. And also if we're saying the person is resident, person can be ordinarily resident in India or the person can be non-ordinary resident in India over there. So there are two subtypes of the resident in India also, right? One, it is ordinary resident, and the other one, it is non-ordinary resident in India over there, right? Now let's understand the different terms and what are the criteria related to the same. Now for the residential purposes, as per the tax guidelines over there, if the person is staying in India for more than 182 days, if a person is staying in India for more than 182 days over there, in that scenario, the person is considered to be resident in India. The person is considered to be a resident in India, and also the person must be staying in India for a period of 60 days or more during the previous year. For 60 days or more during the previous year. So the first particular condition is related to 182 days. Minimum stays days in India must be for 182 days, and further it's related to that the person must have stayed at least for 60 days during the previous year, and particularly for 365 days. For during the previous year, it is 60 days, and for 365 days or more during the previous year. During the previous year, right? Relevant to the previous year, and other than that, the person must be having 365 days stays in the previous 4 years over there. Now that will be related to the person will be said to be the resident in India. Only then the person will be said to be a resident in India. So the person must be staying for greater than 182 days in the last year, and also at least for 60 days in the previous year, and also for 365 days for the last 4 years over there. Then the person will be resident in India, right? Now, as per the new amendment that is active from the financial year 2021 over there, a citizen of India, a person who is a citizen in India, who is not liable to pay tax in any other country, he is not liable to pay tax in any country, is resident in India, and further, let's say case person A who is citizen of India and is having no liability outside India so as to pay tax in any other country over there, and particularly he is having the residential status in India. He is having the resident status in India, and particularly if their income from the local sources over here in India is actually exceeding 15 lakhs, that is greater than 15 lakhs over there, and they have no tax liabilities in the other countries over there, the person will be considered to be resident of India. Try to understand, as per the new amendment, what happens that if you are having the citizenship in India, if the person is having the citizenship in India and having no tax liability outside India, and in India the person is having the total income excluding the income from the external sources or from the global sources or from the foreign sources, it is exceeding 15 lakhs per annum over there, in that scenario the person will be considered to be resident in India. The person will be considered to be resident in India. Okay, so that are the two conditions we have learned about. These are very much important. Can you please take a note? Now let's understand about the ordinary resident in India. I told you now, in residents also, if the person is said to be the resident in India, there are two categories. One, it is related to ordinary resident in India, and the other one, it is non-ordinary resident of India over there, right? So first of all, we are talking about the ordinary resident of India, ordinary resident in India over there, right? Now the person is to satisfy the two conditions for that particular regard. First of all, it's related to the person must be residing. Let's say case we are talking about the previous year, that we are talking about the financial year. Now relevant to this particular financial year, if we draw it on timeline, for the last 10 years, let's say it's 0, for the last 10 years the person must be staying for at least 2 years in India, relevant to the financial year and for the last 10 years. Okay, so this is the assessment year we are having. On the one, we are having the assessment year, and relevant to the financial year we were having to do that particular financial year, previous 10 years, the person must be staying for at least 2 out of 10 previous year, right? And further, the person is to reside in India for a period of 730 days or more. The person is to reside in India for 730 days or for this particular period also, from this period to last 7 years, a particular person must be residing for 730 days or more in this particular period over there. Okay, so these are the two conditions which are to be taken care of. So the first condition is related to relevant to the previous year. In the last 10 years, in the previous 10 years, the person must be residing in India for at least 2 years, and also relevant to the previous year, for the last 7 years, person must be residing for at least 730 days or more. Then in that scenario, the person will be considered as an ordinary resident in India over there, right? But it's related to resident but not ordinary resident. If the person is not satisfying any of these two conditions I told you, then the person is a resident but not ordinarily resident in India, right? Now let's understand the non-resident condition over there. Non-resident condition over there. So if a person or individual is not satisfying the condition related to resident of India, related to ROR, related to RNOR, that is resident but non-resident of India, resident in India conditions over there, in that scenario, that particular person will be considered as non-resident over there, right? So if you're not basically satisfying conditions to the residentialship in India over there, then you will be considered as non-resident in India over there. And further, if we talk about the taxability over there, if we talk about the taxability over there, in case of resident, a person who is resident and also who is ordinarily resident in India over there, it is to be charged, it is to be charged on the tax on the global income. Let's say if you are a resident in India or you are resident, ordinary resident in India, in that scenario, whatsoever the global income you are having, let's say case you are earning from the external sources also, you will be charged tax on those sources also. You'll be charged tax on those sources also, right? And particularly if you are NR, that if you are non-resident, if you are non-resident, or if you are non-resident or ordinary not you're not ordinary resident, not ordinary resident, in that scenario your tax liability in India will be limited to the income that you have earned in India only. Income that you have earned income in India only, but not related to income that you have earned from the global company, or particularly let's say from any other foreign company over there, right? In that scenario, no tax liability on your foreign income in case you're having the status related to non-resident or non-ordinary resident over there, right? Further, it's related to DTA. Now, DTA is actually related to what? It is double taxation avoidance agreement. It is double taxation avoidance agreement over there. What does it indicate? That it's particular treaty signed. Let's say case A country has signed a treaty with the B country, so that the individual who is living in any of those countries is not levied tax double, right? There no taxation is particularly done double in that particular scenario over there, right? So it basically helps the taxpayers so as to avoid paying double taxes on their income earned from one source country as well as in the residence country over there, right? That is DTA. Okay. Further, it's related to income slabs. Now, we are having the different tax regimes over there. We are having the old tax regime, we are having the new tax regime. First of all, let's understand the old tax regime over there, and that was actually applicable up to assessment year 2021 over there, up to 2021 over there. In the old tax regime, there were particularly different scenarios for the different categories. Like there were three categories for the same. We were having the normal individuals, which are having the age up to 60, and we were having the senior citizens, which were having the age up to 60, from above 60 years up to 80 years, and we were having the category related to super senior citizens, related to the who are aged more than 80 years over there, right? And as per the old tax regime, there was no tax slab or particularly nil tax rate up to 2.5 lakhs, from 2.5 lakh to 5 lakh rupees for the particular individuals. We're not talking about the senior citizens or super senior citizens. For normal citizens who are having the age up to 60 years, for 2.5 lakhs there was no tax slab, and from 2.5 lakh to particular 5 lakh there was 5%, from 5 to 10 lakh there was 20%, above 10 lakh over there was 30% of the tax which is to be charged, right? And for the senior citizens, resident senior citizens, the slab was particularly up to 3 lakh. There was no rate, right? Like I told you, up to 60 age, the minimum slab was 0 to 2.5 lakh. There was no tax, right? But in case of senior citizens, it is from 0 to 3 lakhs. There is no tax. And for super senior citizens, it is 0 to 5 lakhs. There is no tax for this particular thing, right? And the second slab is related to 3 to 5 lakh, 5 to 10 lakh, 20%, above 10 lakh, it is 30%. And also for the super senior citizens, there is only these slabs are applicable. That is up to 5 lakh. No particular tax will be there, and from 5 to 10 lakhs there will be 20% tax levied, and above particular 10 lakhs 30% tax will be levied. Okay. And income tax exemption limits, as we have already discussed, in case of individuals up to 60 years, income tax was exempted up to 2.5 lakh. For senior citizens, exempted up to 3 lakhs. For super senior citizens, it was exempted up to 5 lakhs over there, right? That's the scenario. And if we talk about the surcharge, now surcharge is applicable on the tax over there. Let's say case you basically calculated the tax for you, and you calculated to be rupees 1000 over there. Now surcharge would be applicable on this particular 1000 rupees over there. And further, if you are having the income range from 50 lakh to 1 crore over there, 50 lakh to 1 crore, then the surcharge of 10% will be applicable. if you're having the income from 50 lakh to 1 crore, then the surcharge of 10% will be applicable. And if you're having the income above rupees 1 crore, then surcharge of 15% will be applicable. And education cess and health cess will be applicable 4%. Will be applicable 4%. So surcharge will be applicable as per the old tax regime. From 50 to 1 crore, it is 10%, and above 1 crore it is 15%, right? And particularly for education cess and health cess, it is 4% on of the total income tax amount, right? Now let's understand the new tax regime. Now as per the new tax regime, there is no tax, or tax is exempted up to rupees 3 lakh, for 0 to 3 lakhs, and it is all same for all the classes of individuals. 0 to 3 lakh there is nil tax, and further from 3 to 6 lakh it is 5% of the tax which is applicable, and from 6 to 9 lakhs it is 10%, and 9 to 12 15%, 12 to 15 20%, and above 15 it is 30% of the tax which will be applicable over there. There is a huge tax which is applicable over there, that is particularly in the steps of 5%. 0 to 3 no, 3 to 6 5, 6 to 9 particularly 10, 9 to 12 15, 12 to 15 20, and further above 15 it is 30%. There is step of 10% in this scenario, okay, that is above 15. And for the income tax exemption limit, for as per the new tax regime, it is 3 lakh rupees over there. And further, if the individual's total taxable income, kindly please do understand, if the individual's total taxable income is up to rupees 7 lakh, let's say case person A is here, and the person A is having the total taxable income up to rupees 7 lakhs over there, up to rupees 7 lakhs over there, in that scenario they will be getting a tax rebate under the 87A, tax rebate under 87A as per the new tax regime. It will be given for the fiscal year 23-24, for the fiscal year 23-24, that is particularly applicable. Tax regime tax help will be given at 25,000 rupees. Let's say that tax regime will be applicable to those individuals who are having the taxable income up to rupees 7 lakh over there, right? Up to rupees 7 lakh over there, right? After that, it's related to surcharge applicability. If you talk about now, if you're having the income 50 to 1 crore, 10% surcharge. Above 1 crore to particular, in the old tax regime it was 15%, but now as per the new tax regime, it is particularly for 1 crore to above 1 crore to 2 crore it is 15%, for 2 crore to 5 crore it is 25%. If you're having the income range above 5 crore rupees, then 37% of surcharge will be applied, and surcharge is applicable on your net on your tax amount over there, right? And if you talk about the education cess and health cess, it is particularly retained at 4%. Okay, so that's the scenario related to it. Now as per the new tax regime, whatsoever the benefit or exemptions or deductions which were applicable before, now not applicable. You're not getting any deductions or exemptions for HRA, for particularly house rent over there, or standard deduction on salary is not applicable. Even if you're earning interest, particularly have not earning, if related to interest deduction on housing tax, on housing loan under the section 24, that is also not applicable over there. And also there is no deduction applicable under section 80C, 80D, 80E. There is no exception, but there is no particular exemption allowed or deduction allowed, but only under the section 80CCD, only under the section 80CCD, under the investment under the NPS, that is a notified pension scheme, that particular deduction is allowed. Okay, otherwise no deduction is allowed. Okay, and what exemption or deductions are allowed, let's have a look at it. Transport allowance for especially abled persons. Transport allowance, if you're basically spending any on that particular thing, deduction will be allowed. Conveyance allowance for expenditure incurred for traveling to work, for that particular purpose, deduction is allowed. Investment in notified pension scheme under 80CCD, that will be allowed. Depreciation under section 32 of the income tax, except additional depreciation, that will be allowed. Any allowance for traveling for employment or for transfer purpose, that particular allowance is deductible under the new tax regime. But other than that, no benefits related to deductions are allowed. No 80C, no 80D. 80C is actually related to what, that basically, let's say PPF investment, or particularly let's say ELSI, or let's say you have invested in a provident fund over there, or let's say you have invested in different kind of NPS or KV schemes over there, that is actually covered into 80C, and benefit was available up to rupees 1.5 lakh, that now is not applicable. And under 80D you were getting the reductions related to medical expenses, or particularly let's say insurance, particularly you were taking medical insurance, you were taking, that benefit was available, right? So those are not available. And also the benefits which were available, like for under the 24, section 24, you were getting the benefits related to the housing rent. you are getting the benefit for the housing rent, right? So whatsoever the rent which is paid on the housing loan over there, that was also deductible up to rupees 2 lakh in case of section 24, right? And extra deductions were allowed under section 80E over there, that is also not allowed. And also for education loan, the deductions are not allowed now, right? So that is actually not allowed as per the new tax regime. Now let's understand this case study. Mr. Rao is there, who is aged 52 years. That's a normal resident, and particularly he's having a income, a salary income of rupees 10 lakh. His total investment under 80C is 1.7 lakh under ELSS, equity linked savings scheme, a provident fund, LIC premium, and for the principal installment of home loan, etc. And further, he pays medical insurance. So he has paid the medical insurance for himself and his wife, rupees 28,000. He has paid a home loan interest of rupees 75,000. Which tax regime would be more beneficial? Now we have already learned about the different scales and different particular tax slabs over there. Now as per the old tax regime, what was the different particularly scenarios for the person aged 52, who is basically normal resident, right? For 0.25 lakh, there is no tax applicability. For 2.5 lakh to 5 lakh rupees, there was 5% of the tax, and for 5 lakh to 10 lakh over there, there's 10% of the tax which is applicable over there, right? That was the slab we'll be learning about. And for the other than that, the other benefits were also applicable, right? So now let's have a look at it. So if we look at the as per the old tax regime, so we are having the gross income of rupees 10 lakh over there. And if we look about the deductions over there, there is particular deduction of under 80C, which is maximum allowed for 1.5 lakh, as I told you. And over here he has invested up to rupees 1.7 lakh, but the maximum deduction would be applicable for 1.5 lakh over there. So we deducted the same such to calculate the taxable income, right? And under 80D, the maximum deduction is allowed for 25,000. And if you're paying for your medical insurance for your parents, then in that for senior citizens, in that scenario, it is another 25,000 is applicable for if you're paying for your parents. And further, if you're paying for senior citizens, in that scenario, deduction of 1 lakh rupees is applicable in case of 80D over there, right? And for 24B, maximum housing interest for which the deduction is allowed, that is up to rupees 2 lakh. So wholesome amount of 75,000 rupees will be deducted. So our taxable salary over here is 7.5 lakh. It is 7.5 lakh. Now out of this 7.5 lakh, for 0 to 2.5 lakh, no tax will be levied. And for 2.5 lakh to 5 lakh, 5% tax will be levied. That amounts to 12,500. And also for another 2 lakh 5,000, that is from 5 lakh to 10 lakh, 20%, not 10% over there. I basically wrote it wrong. 20% tax slab is applicable. So it is actually 50,000 over there. So the total tax liability is 62,500. So the total tax liability is 62,500 over there. And if we talk about the new tax regime, the tax slabs are what? That no taxes, no tax slab up to 3 lakhs, 3 to 6 lakh, 5%, and for the 6 to 9 lakh, 10%, and for the 9 to 10 lakhs, 15% over there. And there is no deductions, exemptions allowed so far, as per mentioned, as we have already discussed. Now the tax for 3 to 6 lakh, it is 15,000. 6 to 9 lakh, it is 30,000 we calculated. And for 9 to 12 lakh at 15%, for 1 lakh rupees, it will be 15,000 over there, right? So this is the total tax which will be there, that is 45,000 plus 15,000, that is equal to 60,000 over there, right? So the total income tax that will be applicable as per the old tax regime, it is 62,500, and as per the old tax regime, new tax regime, it is 60,000 over there. And also education cess and health cess will be applicable at 4%. Now this particular 4% is applicable on this amount, tax amount over there, not on the total amount over there, not total taxable income, but on the income tax we calculated. So it amounts to 2,500 in this scenario and 2,400 in this scenario. So the total tax outgo would be equal to 65,000 in the old tax regime case, and in the new tax regime case, it will be 62,400, right? Now definitely the person must be going for, but the person must be going for the new tax regime, right? Now if we talk about the nature of income, if we talk about the nature of the income over there, if you're getting the income from the salary or any other head of income which is actually attracting the TDS over there, employee can actually opt to choose for the new tax regime, and for the that is to be intimated to the employer. Let's say case you are a salaried person, in that scenario, or particularly tax TDS is being deducted under any of the category. In that scenario, you are to basically intimate to your employer that which particular tax regime you want to select for, right? And particularly if you're getting the income from business or profession, in that scenario, you'll be getting the option to choose from the tax regimes, that is the old tax regime and for the new tax regime over there. But particularly you can be selecting it for once only. It's not the case that you can be shifting it for multiple times. You can be either be you can be selecting it for one time only, that you want to basically go for the old tax regime or for the new tax regime over there, right? And further, it's related to investment products for tax savings over there. Now let's have a look at it. First of all, it's related to ATC. Now ATC is actually applicable to, let's say, case that you are paying the LIC premium, you are particularly investing in ELSS over there, or particularly, let's say, you are basically investing in a provident fund, or you're basically investing in a PPF over there. Now in that all scenario, your deduction would be covered under section 80C, which is maximum applicable up to rupees 1.5 lakh yearly purpose over there, right? And further we have the PPF. Now PPF, we can making the maximum contribution of rupees 1.5 lakh per year, and further this is account is operable for the next 15 years, and further can be extended for the next 5 years also, right? And the second one, it's related to ULIP. ULIP is actually ULIP. ULIP is what? Unit linked insurance plan. It is unit linked insurance plans. And further, ULIPs, these are tax saving schemes. These are tax saving schemes, and maximum exemption up to rupees 1 lakh is applicable under 80C over there. Under 80C over there. And apart from the investment exemption, the maturity earnings are also tax exempted. So whatsoever the maturity earning will be there under the ULIP, that is also exempted from the tax. And also whatsoever the interest it will be earning under the PPF, that is also not taxable, right? And further, it's related to tax saving FDR. Now in case of tax saving FDR, you can be investing and investing the money in that particular tax FDR over there, and that is having the lock-in period for at least 5 years, and particularly whatsoever the interest will be earned, that is taxable. That is taxable, and you can be maximum investing rupees 1.5 lakh per year in tax saving FDR, right? And for the employee provident fund, now EPF actually allows the tax benefits of rupees up to rupees 1 lakh over there. And if we talk about the NSS, that also allows the benefits up to rupees 1 lakh over there. If we talk about the tax saving mutual funds, that also allows the benefits up to rupees 1 lakh over there. And if we talk about the post office tax saving schemes, the benefit up to rupees 1 lakh are applicable throughout the year through the post office investments over there. And if we talk about the life insurance premium, the benefit is available maximum up to rupees 1.5 lakh, whether you are paying for yourself, spouse and children, dependent children over there, that is also allowed as deduction, right? And further, it is for the Sukanya Samriddhi Yojana. Now what is SSY scheme over there? There is a Sukanya Samriddhi Yojana over there. It's a government saving scheme. It's a government saving scheme. And further, to the girl children who are basically who's 10 years or less, that scheme is basically applicable for those. And further, it is having a lock-in period up to the age of daughter is basically she attains a age of 21 over there. And further, the principal amount qualifies for the deduction, and interest is tax-free. Interest is also tax-free, and the account will mature at what point? When the daughter will be attaining the age of 21 years, or particularly related to the event of the marriage of the girl child over there, right? Further, it's related to Pradhan Mantri Vaya Vandana Yojana. Now, persons who are aged 60 or more, right? Who are aged 60 years or more, and that's a pension fund scheme. It's there. It's a pension scheme is there, and particularly in that scenario, Pradhan Mantri Vaya Vandana Yojana, the senior citizens will be earning a assured interest of 8.3% per annum. In that scenario, by Pradhan Mantri Vaya Vandana Yojana, the minimum lock-in period is 10 years over there, and principal amount actually qualifies for the deduction, and whatsoever the interest will also be earned, that is also tax-free, right? Further, we are having the senior citizen savings scheme. We are having the senior citizen savings scheme. So provide so as to provide this regular income to those persons who are senior citizens age 60 or more. They will be provided with the certified bank, particularly available with the certified bank over there. And whatsoever the balance actually is invested, maximum to rupees 1.5 lakh over there, that is also, and tax deduction is allowed under 80C over there, and it is having a lock-in period of 5 years. It is having a lock-in period of 5 years over there, and also whatsoever the interest is earned, that is also tax-free. That is also tax-free. And if we talk about the ELSS, that is an equity linked saving scheme. If you basically invest into such securities which are covered under the ELSS over there, that also allows a deduction under the 80C for amount up to rupees 1.5 lakh, and they are also having a minimum lock-in period of 3 years. ELSS is also having a minimum lock-in period of 3 years. Okay, so that's the case. So if we talk about the PPF, PF, ULIP, tax saving FDR, employee provident fund, NSCs, or particularly post office schemes, life insurance schemes over there, Sukanya Samriddhi scheme over there, or particular Pradhan Mantri Vaya Vandana Yojana, senior citizen savings scheme over there, equity linked savings scheme over there, all are covered under the 80C over there, right? Now, other tax saving options other than the 80D, let's have a look at it. Let's consider those also. So first of all, it's related to the 80D. That's particularly applicable for the medical insurance premium that you're going to pay, and that can be claimed at rupees 50,000. 25,000 rupees for self, and for the 25,000 rupees for the dependent parent who are below 60. And also one can claim up to rupees 1 lakh over there, 1 lakh over there, if the age of parents is 60 years or more, if the age of parents is 60 years or more, right? And for the, if we talk about the section 24, if you're basically having a housing loan, and particularly let's say case you're paying the principal, that is actually related to principal amount you're paying, and also you're paying the interest over there. Now as per the section 24b, as per the section 24b, what's the interest amount you're paying in one particular year, up to rupees 2 lakh, it is allows, it can be allowed as deduction, it can be allowed as deduction in that scenario, right? That is under it. And for the, it's related to section 80 EE, section 80 EE. Now section 80 EE also allow the deduction of the housing interest rate or interest loan over there, but it's over and above rupees 2 lakh. Let's say guys, total interest that was charged in your housing loan for this particular year was 3.75 lakh. Now the maximum deduction that you can take under section 24b, it's basically allowed up to rupees 2 lakh over there, and extra deduction of 50,000 can be allowed under section 80E. So the total deduction that will be allowed to you will be 2 lakh plus 50,000 over there, right? And further it's related to section 80. Now that's actually deduction for the interest that you have paid for the education loan, right? For the education loan over there, right? Further it's related to capital gains tax. Now I already told you what is capital gain. Let's say case that you are having an asset of rupees 2 lakh in 2000, and then you pay, you basically sold that particular asset in 2020, let's say for 50 lakh over there. Now in that case scenario, it is a long-term capital gain. It's a long-term capital gain because you hold the asset for more than 1 year over there, right? And also you are having a capital gain of 48 lakh rupees over there. You are having a capital gain of 48 lakh rupees over there, but that's not the case. That's actually not the actual capital gain that you had, because there was also inflation involved. There was also inflation involved, and this value is to be calculated in such manner. So we'll be also learning that how we can be calculating a pure a particular right value, right? So first of all, let's have a look at the short-term capital gain and the long-term capital gain. So if we talk about those securities which are actually listed on recognized stock exchange, for those securities which are listed on recognized stock exchange, in that scenario, if you are holding the particular asset for particular and holding and selling the particular asset for in the period lesser than 12 months, then it is considered to be short-term capital gain. And particularly if you're holding the asset for greater than 12 months over there, it will be considered as long-term capital asset over there. And if we are talking about those particular securities which are unlisted, right? And further, if you're talking about the land or building over there, in that scenario, if you're talking about the unlisted assets over there, unlisted securities, or if you're talking about the land or building over there, in that scenario, it will be considered as a short-term capital asset if you're holding for lesser than 24 months. If you're holding for lesser than 24 months over there, lesser than or particularly equal to 24 months over there. Okay, and further, if you're holding it for greater than 24 months, it will be considered as long-term capital asset for the unlisted shares and for land and building over there. And further, if you're talking about the unit of debt oriented particular funds over there, or we're talking about the unlisted securities other than shares over there, or the other capital assets over there, for that particular case, if we are holding the asset for greater than or for lesser than or equal to 36 months, it is short-term capital asset over there. And further, if you're holding the asset, those particular assets which are unit of debt particular funds over there, or unlisted securities other than shares over there, now in that scenario, if you're holding it for greater than 36 months, then it will be considered as long-term capital asset over there, right? So that's actually related to the definition of the short-term capital asset and the long-term capital asset, dependent upon the various types of the assets, and further based upon the holding of that particular asset over there, right? Now let's consider that particular part about the important terms over there. First of all, let's lead to full value consideration. Now, what is actually full value consideration? Full value consideration is the consideration amount, the total consideration amount that has been received by the seller. Let's say that A is a person who has sold the asset. Now, person A has received rupees 10 lakh over there. Now, rupees 10 lakh is the full amount consideration over there. Now, after that, it's related to cost of acquisition. Cost of acquisition means at what cost this particular asset was acquired. Let's say case particular person A acquired this asset in year 2000 at rupees 2 lakh. At rupees 2 lakh. So this will be the cost of acquisition. This will be the cost of acquisition. And also let's say case person A has spent for the additions or alteration on this particular asset. Let's case he spent rupees 1 lakh on the same. So that will be added to it. So that will be what? That will be the cost of improvement. That is the cost of improvement. So this is cost of acquisition, and particularly this is COI, that is cost of improvement over there, right? And also other than that, it's related to indexed cost of acquisition or indexed cost of improvement over there. Why it is to be calculated? Because I told you that in the some year the inflation was something, and now the inflation is there because there is a general trend in rising of the prices over there. So we also need to consider the inflation over there. It's not the case now that the value today will be remaining the value tomorrow, and further we'll be saying it a capital gain. So we cannot be considering it a capital gain. We need also to consider the factor related to the inflation over there, right? So that's the main thing related to it. So we can be calculating the index cost of acquisition as what? It will be the cost of acquisition. It will be the cost of acquisition multiply the cost index over there, cost index or cost inflation index over there, cost inflation index over there in the year of sale, CII, that is the cost inflation index in the year of sale, and further divided by the cost inflation index in the base year, cost inflation index in the base year over there, right? So that is to be considered. And also the same way the index cost of improvement can be considered. So what's the cost of particular improvement, that is cost of improvement multiplied by the CII in the current year of the sale, and particularly the CII in the base year, CII in the base year over there. So that is to be calculated if we want to basically calculate the appropriate right value, as I told you earlier also, right? Now after that, it's related to section 54. Now section 54 is actually related to what? It's related to exemption of sale of housing property on purchase of another housing property. On purchase of another housing property. What does it indicate? It indicate that, let's say case that a person A purchased a property in year 2000 and particularly sold in year 2020. Sold it in year 2020. Now the person is actually eligible that he is to pay the long-term capital gain. The person is to pay long-term capital gain, right? If there was particular capital gain was there, right? That is the case. But long-term capital gain is exempt on the sale of housing property, because if person A invest into other housing property, if the person A invest into other housing property, or particularly or one or two properties over there, it's not related to they can be investing in one property over there. In that scenario, it is allowed that person A can be investing into two different housing properties over there. And in that scenario, what will happen? In that scenario, the capital gain on that particular asset will be, that particular housing property, that will be exempted, right? But the condition is this, that the capital gain on selling of that previous property should not be greater than 2 crore rupees. But if the capital gain on selling of the property was greater than 2 crore rupees, in that scenario, the person this particular exemption won't be applicable. This particular exemption won't be applicable in that scenario. Okay. And then it's related to section 54F. Section 54F, that is exemption on capital gains on sale of any other assets than the housing property. It's not related to that you will be getting the exemption related to housing property only. That's covered under section 54. But if you sell any other asset also, and you have if the capital gain was there and exemption related to the same, that can also be there. If that particular amount has been used to acquire a new residential property, let's say case person is sold any other capital asset and there was capital gain. Now particular person, if he basically purchases a house property over there, in that scenario there is exemption from the long-term capital gain. But the scenario is this: the property needs to be purchased either 1 year before. So let's say case that you basically sold the asset in year 2024. In that scenario, either you must have purchased the housing property up to 1 year before, that is 2023 to 2024, or in the next 2 years, that is up to 2026, you have to purchase a property, then this exemption will be allowed, otherwise not, right? That is the case over there. And further, if you have purchased a property, in that scenario, the exemption would be applicable only if you complete the property, if you complete the construction in the next 3 years from the date of sale, right? Let's case you basically purchased a plot in particular year 2025. Now from the date of sale, this is a date of sale, from this particular thing, between 3 years you have to complete the construction of this particular property over there. In that scenario, you can be taking the exemption of the same. Okay. Further, it's related to section 54EC. 54EC, that's actually related to exemption on sale of housing property on reinvesting in specific bonds over there. Let's say case you were basically having some long-term capital gain, and whatsoever the amount you were having the long-term capital gain, so whatsoever the amount it was, you basically reinvested the amount into some specific bonds over there or government bonds over there, up to rupees 50 lakh only, up to rupees 50 lakh only. And that particular bonds will be having a lock-in period of 5 years. They'll be having a lock-in period of 5 years over there, and they cannot be sold before 5 years from the date of sale over there, right? They cannot be sold before the 5 years over there. And particularly the investments need to make, let's say case you basically sold the property on 1st January 2024, then in that scenario you need to invest the funds, you need to invest the funds maximum by 30th of June 2024 in the specific bonds, so as to basically take the benefit of this particular exemption, so as to take the benefit of this particular exemption over there, right? Further, it's related to tax treatment of gifts received by individuals. So if anything that you are receiving, any sum of money that you are receiving without any consideration, it is particularly said to be monetary gift over there. And if you basically specified movable properties are received without consideration, that is basically gift of movable property over there. And particularly if any movable property is received at a reduced price over there, that is actually said to be movable property received at a less than fair value market value over there. Let's say case you basically received a movable thing, you basically received a movable asset that was actually having a fair market value of rupees 20 lakh, okay, but you received it for rupees 2 lakh over there. That will be considered as what? That will be considered as a movable property received for less than its fair market value over there. It may also be the case that you may have received an immovable property without consideration. It is said to be gift of immovable property. And it may also be the case that you have received the immovable property received for less than its stamp duty value over there. And further, these are the different scenarios related to it, okay. And the aggregate value of such sum of money receiving during the year, if it exceeds rupees 50,000, then it's taxable, then it is taxable over there, okay.